And welcome back to yet another exciting week of the Lazy Money Game. In this week's episode, I will start by explaining the concept of Tactical Asset Allocation, or TAA in short. This is due to the fact that I have received a question from the audience if I could try and explain what this concept actually means. So of course I will do that, and afterwards I will give an update to my portfolio as well. So let me start by trying to explain this tactical asset allocation. So first of all, if we start with an asset allocation, here I have made a pie chart where you can see an asset allocation. So assets is, for instance, cash, bonds, stocks and commodities. And here you can see how the percentages are distributed between the different categories. Well, the tactical part now comes into play. If you, for instance, believe that in the near-term future, bonds and cash are not going to do well, that could be, for instance, if you are expecting the rate to increase, then for a shorter period of time, you're willing to let your allocations in those two assets go down, and at the same time, you're willing to have a higher percentage of your assets in a different allocation, which could be commodities or stocks, for instance. So over on the right here, I have simply just illustrated how such an tactical asset allocation could look. If you, for instance, lower the percentage you have in cash and lower the percentage which you have in bonds, and then you have reallocated that into commodities and into stocks. Notice here that the tactical asset allocation does not say anything about which stocks or which commodities that you are going to buy. It simply just revolves around this theory that you believe that these assets are going to do better in the near-term future, and later, when you think that there is no increased potential of having this distribution, then you will return to your original asset allocation distribution. So what determines your original asset allocation? Well, that is your risk profile. So if you don't like to see that your portfolio is fluctuating a lot in value, meaning that it goes up a lot or goes down a lot, well, then you need to have something in your portfolio that stabilizes it much more. So in that case, for instance, you want to have more bonds in the portfolio, since they tend to remove a lot of volatility, since bonds are much less volatile than stocks. Stocks move up and down much more in value than bonds. So if you don't really want to have a lot of risk in your portfolio, then you typically have a lot of bonds. If you don't mind that your portfolio can fluctuate a lot, then you will increase the amount of stocks that you have. And why do you have cash in your portfolio at all? Well, usually it's not advisable to invest all your money, that you will also want to have some cash, so you also have some liquidity, so you can always pay all your unforeseen bills. So who is using tactical asset allocation? Well, if you have ever read some of the financial news in the newspaper, then you will from time to time see articles where a professional money manager or an investment bank says a quote like this: "Currently, we believe that stocks will do better in the next 6 to 12 months. Hence, we believe that you should have an overweight in that asset group." And at the same time, they don't really specify what you are supposed to underweight. They simply just come out with a recommendation saying that this is where you should allocate more than what you would typically do. Of course, it could also be the controversy saying that currently we see that commodity prices are to go down. Hence, we believe that you should underweight this asset group in your portfolio. But from time to time, you will also see much more prominent names who have an opinion about tactical asset allocations, such as this year, where Warren Buffett was quoted, "Now is not the time to buy bonds." This is due to the fact that everyone, including himself, knows that the interest rate at some point will have to rise. we cannot keep the interest levels at the level where they currently are. So if you are buying bonds when the interest rate is really low, then you're not really getting a good return on your money. The only thing you're guaranteed is to get your principal back in 10 or 20 or 30 years from now, depending on the maturity on those bonds. But if the interest rates increase, then you will be capable of buying bonds at a later point with a higher yield on them. Hence, the bonds that you are buying today with this low interest rate environment won't be worth that much compared to the bonds that you can buy later after the interest rate has increased. So hopefully this answered your question about what tactical asset allocation is. Otherwise, feel free to comment down below if there's something that you want me to try and explain in further detail. Now, let's turn to my portfolio and see how it has performed within this week. So the first thing you immediately notice is that there's a green circle for this week's episode, meaning that the portfolio is up in value compared to last week. We go to the portfolio values tab, you can see that it has increased with $1,600. But perhaps more interestingly to you is, if we go back to the overview here, you can see that there now is an amount in the cash line and there's an amount in the cash line on the value, meaning that I have actually sold out of a position within this week. Before we get into that, then let me go into my favorites tab, namely the dividends tab, just to show you that this week I have received a little more than $40 and they came from General Dynamics. So now I have received a little more than $214 this month so far. And at the same time, you can see that the company which I have sold out of had a higher yield than the 3.12 on average that my portfolio had last week. So that's why the estimated average yield has gone down as well. If we then continue with another really interesting news for my portfolio within this week, then it is the fact that Organon came out with a really good quarterly result, and at the same time that they will now instate a dividend of 28 cents per share, which they are going to pay on a quarterly basis, meaning that I am going to receive a little more than $5 for my next dividend payment. I know that the dividend yield over here looks extremely high. This is of course due to the fact that I have a really low buy value for Organon, since I have received my shares in Organon as a spin-off from Merck. So basically I actually paid 0 for the 200 stocks which I have. And due to the fact that this will break down if I enter a buy value of less than the $1, which I have done over here, well, then it makes the dividend look extremely high. So let us just for a moment look at the stock chart for Organon within the last week. So here you can see the weekly chart. And I mean, what day do you think that Organon came out with their quarterly result? If your guess is on the 12th of August, then you are correct. And I mean, obviously they came out with good quarterly results. And I know that the theory says that dividends are irrelevant. But I mean, if you look at this, is it then so far-fetched of an idea to think that dividends actually matters? I mean, I know this is not a proof, I know this is not science, but I'm simply saying, when you look at a graph like this, it's not completely unimaginable to me that there should be some people that actually cares about whether or not a business pays a dividend. So since I started this video by explaining about tactical allocations, perhaps a good way to end the video is explaining whether or not I'm actually using tactical allocation myself. So first of all, if you look to my portfolio, I'm 100% invested in stocks. I know that when I'm recording this video, that is actually not true, since there is some cash in the portfolio. I'm simply just displaying this so you can see that I have sold out of a position I of course intend to reinvest that money as well, just to clarify that. So the way that I'm using tactical allocation is very, very different, because it doesn't really matter to me whether or not some of the big banks are communicating that they believe that stocks are to move up a lot in value within the next 6 to 12 months. I mean, I already have 100% in stocks within this portfolio. So how would I use that news? Should I then go and borrow money to get even more exposure if I wanted to have more than 100%? Well, and you could say that I'm using it in a different manner, since for instance I don't have any bonds in this portfolio, and that is very true due to the fact that I don't believe that bonds are a good investment currently. So you can very naturally see that I'm using it very differently, since I don't have any commodities, there is not any cash in the portfolio, and there's not any bonds. And I mean, of course you can argue that I should put in my entire cash position, because as I have mentioned time and time again, the only thing that I'm showing in my portfolio is actually what I have invested in. And I keep saying that you should always have at least 1 year of savings in cash, so you can cover 1 year no matter what happens to your investment. And that is why I'm okay with having 100%. And that is also why I'm only sharing my portfolio of invested capital. So what do I actually do when I hear this news that, for instance, the big banks expect stocks to go up in value within the next 6 to 12 months? Well, basically I listen, and then I carefully sit down and consider, well, that news doesn't really do anything to me, because it's not interesting for me to know that stocks in general are going to go up. I need to do my own research, I need to do my own due diligence to be able to identify which stocks I believe are currently undervalued, and then I will invest in them. Because 6 to 12 months, I mean, I'm in this for the long run. So 6 to 12 months is simply too short of a time period for me to consider. And finally, I really always try to remind myself about who is sending these messages and what are their potential gains. So typically this information comes from big banks or brokers, and what do they gain from talking about stocks either are likely to move a lot up in value or move a lot down in value? Well, they are incentivizing their users to trade. And what do they gain from that? Every time you and I are sitting and trading, then they will put that commission into their pocket. And since I like to keep my money, I try to trade as little as I possibly can to keep as much of that commission in my own pocket. So that actually sums it up for yet another exciting week of the Lazy Money Game. So hopefully you now know much more about what tactical asset allocation is, and how it is supposed to be used, and how I, as a retail investor, are using a modified version of it in my portfolio. And if you like content like this, then please remember to leave a comment or like the video, or consider subscribing to the channel. It really helps me out. And until I see you next Sunday, bye!